Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options U.S. Market Update. Well, obviously the big news is the markets no longer have the uncertainty of whether or not Russia will invade Ukraine. It's happened. Thoughts and prayers to everyone in that region. In other news, the Federal Reserve's favorite inflation indicator, the PCE deflator, came in and showed an increase of 5.2% for the month of January, another indicator showing the highest reading since 1983. The inflation data just continues to pile on the Federal Reserve. And Bitcoin, even with everything going on, has held 36,000 once again. Pretty impressive. Let's take a look at the charts. At the time of this recording, it's around midnight on Friday evening, so the futures market is closed. Looking at the charts, you can see this big spike down from the open yesterday, but what I'd like to do is walk the charts back a couple days. So if we walk them back to Wednesday's market close, you can see that based on where the 10-day moving average is, we were already just a bit oversold. See the separation from where the close was Wednesday night and the 10-day moving average. Then we get the news Wednesday night that Russia had started the invasion, the futures were down significantly, and then the market opens on the low of the day. Now we're really oversold. And boy, with the rally into the close, all over the financial networks, the pundits were trying to figure out, why did the market rally? We just had the news that the invasion had occurred. Seemed like that would be more negative, but we got this big market rally. Everybody seemed to have an opinion, so here's mine. I feel like the fact that the markets were extremely oversold was part of it, and in the intro, I mentioned the fact that the markets no longer have the uncertainty of whether or not they're going to invade or not. Markets can handle pricing in things. The war, by the way, somebody reminded us on Tuesday night's TradeFinder that they had asked in the beginning of January if they saw any black swans, and I had mentioned war. Wish that one hadn't come to fruition. If you haven't signed up for the TradeFinder, you can do that underneath this video or at our website at ewotrader.com. It's free. We talk about the markets. We look for trade ideas. We have some Q&A. It's a lot of fun. You ought to join us. I look forward to having you. So that's my opinion, is the end of the uncertainty with the market, in the markets and the war, and the fact that we were just significantly oversold. And then, as you know, we did rally back even further today and got back above the 10-day moving average. So that begs the question, was that it? Is that the low? Well, a couple of cases to take a look at. We can look at volume. Pretty decent volume spike, not quite as much of a volume spike as we had on the 24th, which made a temporary low. There was questions about whether or not that was the low or not. Clearly it wasn't, as we've made a new low. So another pretty decent volume spike. And if we take a look at the chart of the VIX, we usually do that at the end, but we'll go ahead and look at the VIX now. You can see we had a pretty good spike in the VIX at the open yesterday. Also pretty similar to what happened on the 24th. And volatility has remained high, and I had talked about, well, is 25 going to be the new bottom? No, that was a bit of an exaggeration and kind of a little bit in jest, but it does seem like there's a case for some pretty good support at 20 before we move down towards the 15 region. So I've said that I think that volatility is going to be a big theme for this year, and it seems like the first part of the year is bearing that out. So back to the charts of the market. Is that the low? I'd like to hear your opinion. Please post a comment underneath the video if you think the market low is in at this point, or are we going to go lower from here? I would like to remind you that in the last recording 2 weeks ago, we showed you this qualified zigzag pattern, and clearly we have broken that low from the 24th, and we're right in between where the 61.8% extension and the 100% extensions are. Would be an odd place for the markets to find a bottom and turn and move back to the upside. So we're back up here testing the 38.2% level. I actually mentioned that to our subscribers on our insiders meeting last night. That's a meeting we have every Thursday night for our alert subscribers only, saying that it would be pretty nice if the markets did move back up to that level and tested that. Could be a good entry for another potential move to the downside. Further reminder that that 100% extension down to around 400 is where that gap was back from the beginning of April. This zigzag pattern is my favorite one, where you have the impulse A, a 61.8% B wave extension. High percentage of the time it does go down and hit that 100% extension. Does that mean that we're going to have a new low? Well, if you believe in the zigzag, as I do, I think there's a pretty decent chance that we likely haven't seen the lows in the market yet. I thought we should take a look at the weekly chart, because we haven't looked at that in a little while, and you can see with that low that occurred yesterday morning, that's a 33% corrective level in the neighborhood of 38.2, so you could argue that that's kind of close enough to where maybe that could mark the bottom on the weekly chart. But then when we start looking at our confirming indicators, they're not very positive. The DMI is actually a pretty good setup for a continued move to the downside. You look at the CCI, and it's moving lower, but it's not at an extreme point low yet, nowhere near what occurred back in March, and maybe we don't go quite as far as that, but you could argue with inflation and war and the fact that the Federal Reserve is going to be raising rates and withdrawing liquidity, those are pretty significant. We argue whether or not it's as significant as COVID or not, but it's pretty significant, I think, in the markets. And then if we take a look at the money flow, you can see the money flow is dried up a little bit. Still on the positive of the zero line, but we're getting this divergence. And if you're familiar with the CMF, divergence is a big part of the indicator. So as the market was going up, we had noted this in the past. I believe the last time we looked at the weekly chart, how as the market was continuing up, this was starting to go the other way, and that's not really supportive of a continued move higher. And that's played out as well with this wave 4 correction. Well, I thought we should look at the 10-year as well, and it was a little bit surprising yesterday with this move to the downside here that we rebounded back to the upside today. Yesterday wasn't surprising to me, today was. And the reason I say that is when you have something significant like war or whatever, the flight to safety, money moving into bonds, and so when people buy bonds, that pushes the rates down. So even though we hit this 2%, and I don't think we're anywhere near done with this, I'd mentioned in the past that I didn't think the markets were going to like 2%. They haven't liked 2% on the 10-year. But then we had all this buying, and then as the market rallied, the money moved right back out of bonds and then moved out again today. So interest rates ticking back to the upside, even as the market had a little bit of follow through on the rally today. In the last recording, I said the one thing that didn't really make sense to me is why with the it seemed like Putin was going to invade. I said that I felt like it was inevitable just because it would have been a sign of weakness with all the news that was going on, and he doesn't seem like the kind of guy that likes to have egg on his face. But with all that, why wasn't there more of a flight to safety into the dollar as there was into bonds? And you can see it occurred yesterday, but then look today, right back down, which I find that still interesting that we didn't hold that spike to the dollar. One argument could be, well, there we are again with that separation from the 10-day moving average, and perhaps we were just a bit overbought in the dollar and just moving back to satisfy the overbought condition, and then we continue higher from here. I seem to think that that scenario makes sense as we move up to that projected wave 5 within this tap box here. Gold. Obviously, as you would imagine, gold spiked to the upside. We closed out our gold trade on Wednesday, so we had one as an alert for our subscribers, a bullish trade, and sure would have liked to have caught that open yesterday, but that's the way it goes sometimes. But note that we closed back below where we exited, so on the closing price of gold, it looks like we made a pretty good exit. I don't necessarily think that gold's done. Looking at the DMI, that's a great looking setup there for a continued move higher in gold. We just have a little bit of resistance here. Once again, we were overbought, so you're overbought, you're at a resistance area going back from June. And so when you're overbought, that's not a time really that you're going to take out resistance. Even as supportive as that DMI is, great separation between the two directional indicators, the ADX moving up almost vertically, a little more than the 45-degree angles, broken above 20. All the factors that you look for in a signal from the DMI are there, telling us that this move so far in gold has some strength to it, and the move is likely to continue. And then we have a forecasted high up here around 187 on GLD within this 5-wave Elliott wave impulse pattern. Silver, a lot of people ask about silver lately, and last time we looked we had this symmetrical triangle here. We did put a strangle on for our alert subscribers, and there's that breakout to the upside. Very similar pattern yesterday, opened significantly higher, closed down lower, and then back up again today. Same type of scenario here. There's a little bit of resistance in silver right around this 23 area, and just kind of want to see if silver can break through that 23 level. When we look at the DMI here, it doesn't quite have the same signal yet that gold does. The ADX is working its way up, but it's not above that negative directional indicator yet, meaning it's between the two, and it hasn't broken above 20 yet. So not the signal yet that silver could continue higher, but within the next couple days it's possible. But the signal actually has to activate. Our subscribers have heard that till they're blue in the face, because I do like the DMI as one of our strong supportive indicators to Elliott wave. Bitcoin, in the intro I mentioned Bitcoin was really impressively, in my opinion, holding this 36,000 level. Once again yesterday it dipped below it, just as it did back here on the 24th, but was able to get back above 36,000. And you know the drill by now. Everything is in blocks of 4,000, it seems like, on Bitcoin. 44,000 is where we had resistance here with that 38.2% wave 4 corrective level. And then we have the next support level at 40,000, then 36, and then 32. So can we get back above 40,000? It seems as though that's been a resistance level over the past 5 or so trading days. So can it get back above there? The 5-wave impulse pattern would suggest that we may move lower here, but with a 38.2% wave 4 correction, it makes sense that that did cause a little bit of a pause here in this move to the upside, but the 4 could go up to 50 or 61.8 and still keep this 5-wave impulse pattern in place. I'm just impressed that every time it tries to break below 36,000, it's able to jump back above it. So we'll see how long it's able to do that, and if that 4 does hold. If we break 36,000, then 32 is next, and then we could work our way on down to that wave 5, which would be kind of a yikes type of a scenario. I've been reading about the halving aspect of Bitcoin, and a lot of confirmation, or a lot of chatter, I should say, about the fact that the next halving, it's H-A-L-V-I-N-G, I have trouble saying that word, halving, part of the programming within the mining for Bitcoin doesn't happen until 2024. So could we be in for a choppy range until 2024? Just an interesting tidbit. I don't know enough about the whole mining aspect and the programming of Bitcoin to know if that is that significant or not. I just thought it was interesting and I'd pass it on. So taking a look at the Qs, and we had talked about that zigzag pattern as well. In the last recording, if you go back and look at the last recording, this wave 3 low was within the tap box, the forecasted wave 5 tap box, but this wave 4 had not labeled yet. And when the wave 4 is right within this projected area, but it doesn't label, that usually suggests that the wave 3 is going to come down lower, and that's exactly what happened. So with the fact that that target price was hit, and it was hit on the wave 3, now the projections for a potential 4 and 5 move. And again, this does not mean that this is the wave 4 underway. It means that if the wave 4 became underway, this is where you could look for a target, but the wave 3 could continue lower from there. But that means we're likely having, at some point in time, lower lows in the Qs from where we are now. Whether or not we get a bounce in the meantime or not, we'll just have to wait and see. Pretty good rally over the past couple of trading days in the market, so is that enough? But note that we didn't get near the rally in the Qs that we did in the SPY. Looking at some of the international markets, as you would expect, these triangles that we showed, significant breakouts. So there's the big breakout out of the Nifty. Big move back to the upside there today. Again, didn't label the 4 though. So can we get another wave 3 lower here? Unless that wave 4 labels soon, that's likely as well. So not looking too good there, but pretty impressive that it jumped back up. But that's part of Elliott wave triangles, right? When you have a corrective triangle and it breaks out, it retraces the breakout. Sometimes immediately, sometimes it takes a little while, but that breakout gets retraced. The DAX, my goodness, the DAX just can't catch a break. Again, relabeling on this wave 5 back to a 3. This is the third time the wave 5 target has been hit, and then it's relabeled to a 3. And I've been doing this for 25 years, and I can remember, one or two relabels from a 5 to a 3, but doing it 3 times, I'm not sure I can remember that before, so pretty amazing to me there. So again, looks like at some point in time we're going to have some lower lows still in the DAX, but at this point oversold, even with the bounce back up today. Didn't quite make it back to the 10-day moving average there on the DAX as we did on our market here in the US. So just thought it would say the poor DAX. It just seems like it can't catch a break there. So we've looked at the VIX already, and I talked about the fact that potentially 20 could be a support level. I do think we're going to have heightened volatility. Whether or not 20 can hold or not, I don't know. Just pure speculation there. I just think volatility is the key, and it's going to be a primary word for the rest of this year, which from an option trader, that's what you want. You ask option traders what do they want in the markets, they're all going to say that same word. Volatility, that's the key. That's when it's really fun to trade. So we look forward to bringing you information the rest of the year, and hopefully you've had a good week. Enjoy your weekend, and we'll be back to talk to you again next week. Take care, everybody.
If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.